Welcome back to the Real Estate Standard. This is episode 20 for the week of May 18th, 2026. I'm Tim Kotzman. I'm here with Kenny Alves and Chris Drizga. Each episode here, we break down how serious operators, investors, and developers stay competitive and profitable in today's market by examining commercial real estate through the lens of Bitcoin. On today's episode, we're going to jump into, is it a bird? Is it a plane? Is it a flywheel? But first, I'm going to send over to Kenny for an update on Westmain storage stacking. Kenny, over to you.
Thanks, Tim. As of today, May 18th, we hold 14.36 Bitcoin. So we have 1.4 billion Satoshis on the balance sheet. So far in 2026, we've stacked 12.17 Bitcoin, so just over 1 billion, 1.2 billion sats. And our Bitcoin yield is through the roof. We'll go through that on the dashboard here in a second. Bitcoin per square foot is at 20,688 Satoshis per square foot. We've been talking about that for the past few months here, and previously talked about how all the CRE in the US is about 97 billion square feet. And if you were to divide all 21 million Bitcoin across it, you'd get 21,649 Satoshis per square foot. So we're approaching that number very quickly. If you were to back out the Bitcoin held by ETFs and public companies and Satoshi's 1.1 million Bitcoin, it would bring it down to 17,000 Satoshis, which we've just surpassed. Our Bitcoin holdings now cover 4 years of mortgage payments, 4 years and 7 months of mortgage payments covered in our Bitcoin holdings. And we also purchased, so we made a big purchase last week, $800,000 into Bitcoin. And we also purchased $800,000 worth of stretch. And we're going to, get into that later today. But some quick math, that increases our NOI by roughly 15%. So now we have a total of 1 million of stretch on our balance sheet. And that's going to generate roughly 115,000 a year in digital rent payments. And that's about a 15% increase in our net operating income. So that's pretty exciting. What do you think about all this, Chris?
I mean, there's a lot I'm thinking about here. There's a lot of different categories and metrics here to just dive deeper on. But a 15% increase in your NOI through just one transaction is incredible, and you didn't even use the entire proceeds to for digital rent purposes. So if you were in a scenario where you needed to maximize the NOI, 15, 20, 25% increase, that's meaningful, to say the absolute least. I mean, did you do the calculation, Kenny, on how many additional units that is in cyberspace here?
We could probably do it real quick, although I don't like to do the public math like Tim says, but we'll have that number for next week. But let's take a closer look at how this transpires with Bitcoin yield and Bitcoin gain here. You can see it's like a god candle compared to our weekly stacking.
Kenny, let's before we jump into this, let's explain to everybody what the heck happened. Over the last week, right? We just came out swinging here for the fences with dramatic increases in the digital rent position as well as the Bitcoin position. So, without giving too much away, as far as what you're working on behind the scenes here, what happened here?
So we were able to raise capital at current interest rates at like 6.5. We actually have a new tab. Let's pull it up while we're talking about it. So we have on our debt tab, we were able to secure 1.6 million at a 6.65% interest only rate. And, you know, we could have just bought all Bitcoin with it. But then we would be kind of dipping into our cash flows from our storage income or from our solar income. And the idea is, how do we preserve that income and like show that we can grow the balance sheet without dipping into that cash flow, without like having a negative impact to our DSCR, our debt service coverage ratio. So that's kind of how we're thinking. And so the way that we see it is, if we with a 50-50 deployment, you can roughly cover. Let's go over to the digital credit tab here. We're like, now that we have $1 million in stretch, and you know, given the debt that we took on, we're almost at break even. We're losing $284 a month right here, and on a yearly basis, that's 3,400. So that's going to be taken out of our commercial real estate cash flow. Our solar income will make up that difference, or we may like do a reinvestment, a drip reinvestment from a dividend payment that we get, and we can catch up so it's self-carrying, and we're basically extracting Bitcoin. So we bought just under 10 Bitcoin, and we're carrying it like all from this one deployment. I don't know if I said that in a way that makes sense, Chris. Maybe you can.
No, I think it makes sense. You raised $1.6 million of capital, and the way you decided to use that capital was to increase the Bitcoin position and the STRC digital rent position. And this, I think this doesn't just go to the broader strategy we've been talking about here, but I think it speaks to the optionality that you create as an operator, right? I mean, this is specific to this asset in this market, right? You have to evaluate every single asset on a case-by-case basis, based off of the rental income, the debt, the location, etc. And this one, the 50-50 split, just happened to be the optimal allocation at this point in time.
Yeah, I mean, I think what we're like trying to do is kind of like de-risk the situation here. We don't have to rely on a future capital raise to service this interest, right? We don't have to sell any stretch to service this interest. Like, we have $1 million of stretch. We could easily peel off and sell either some of the Bitcoin or some of the stretch to make interest payments on the non-recourse loans that we have, or the mortgage, right? But with this setup, we don't even have to like think about it, right? We can just take the dividend income, the digital rental income, and service all of our debt. And it comes in a tax efficient manner, so it's coming in as a return of capital and not as ordinary rental income. So what we're doing is we're capturing the Bitcoin, and we're capturing these tax incentives. So every time we do this, if we were to raise another 1.6 million or another million or 2 million, whatever the number is, and if we deployed it in a similar fashion, we're extracting, we're grabbing the Bitcoin, putting that on the balance sheet, and we're able to service the debt with the digital rental income. And then we also get the tax benefits that come along with those interest only loans. So we've been trying to work with getting interest only, because the principal creates drag for us. Really, we can accelerate with interest only, because that whole loan becomes a tax deduction for us. And so we're stacking like these tax deductions, and we're stacking the Bitcoin, and we're stacking the digital credit, and they, like you said, they create optionality. In the future, maybe we can absorb more Bitcoin. So like we can say, instead of deploying 50-50, we have like the strength to deploy 100% into Bitcoin. Yes, we can kind of cross that bridge when we get there, but we'll have those types of options. And maybe sometimes it's like, hey, Bitcoin just ran super hard. We think we're just going to deploy this week right into this raise into digital credit and generate digital rents for us. And that way, next time we'll be able to buy Bitcoin. So we'll have different levers and different ways to add Bitcoin, digital credit, and then eventually, as we build out the digital credit and the Bitcoin, we can look at growing our real estate. We can actually build out more physical real estate. We can deploy more solar panels, acquire more property, and expand those cash flows as well. And we have this kind of figure eight flywheel, if you will. You have like the Bitcoin, you have the real estate, and you can choose where like you want to put your equity. You can pump the equity out of the real estate and put it into Bitcoin and digital credit, or you can pump the equity out of Bitcoin or borrow against the Bitcoin and the digital credit to acquire real estate. And so you do have this recursive flywheel, but it's like a dual flywheel, right? It's like a figure eight. Like in my mind, when I see it like fluctuate, I see like this figure eight pattern with real estate on one side and digital capital, digital credit on the other.
I want to hit on something there, and this is something that we have talked about here and there on the pod, but you're doing this in real time, and it comes down, or comes back, excuse me, to the original thesis. And part of that is, what is the highest and best use of capital today, right? And in our opinion, the best use of capital is to acquire as much Bitcoin as you possibly can. The second best use is to establish a digital credit position. So you have the cash flow stream, you have the tax advantage, you have the liquidity. The third best use of capital is to acquire more real estate, right? And I think that's been some of the bigger pushback we've gotten from the marketplace is, why are you not deploying this into more real estate? Well, we plan to acquire more real estate, but in our view, there's not enough dislocation or distress in today's real estate markets. So rather than just doing a real estate deal for the sake of doing a real estate deal, we are building up two other capital buckets that have greater appreciation potential, but more importantly, they give us the ability to be flexible, right? It gives the operator, the investors, the ability to be incredibly patient, incredibly intentional and methodical about what real estate they're buying, when and why, right? And that is a big problem in the space today, is that is just not how funds are set up. It's not how people are compensated. It's not the way the real estate world works. So just by flipping that on its head, I think there's some incredibly profound implications to doing that. You not only get to search and select higher quality real estate deals, but you are acting as a much higher quality fiduciary to your investors. And I don't want that to go overlooked, because I think it's incredibly important.
Yeah, you know what it makes me think of? It's kind of like you can create this, like, for a lack of a better term, a SPAC, right? Like a special purpose acquisition kind of vehicle, where the money is just sitting there and growing, right? You're compounding the money. You can reinvest it. You can pay like disbursements to your partners if you want. You have like all this optionality. It's growing. You can raise. It can be like an evergreen thing where you're constantly taking in capital because you have unlimited deal flow. Like, what is the unlimited deal flow? It's Bitcoin and digital credit, and you can just always deploy capital. And that's kind of why we didn't mess around and wait to try. We could have bought Bitcoin today for like a 5-6% discount from last week, but then we wouldn't be in the market ready to try to go raise more capital. So we as soon as we get the capital, we want to show investors that we have a deal. The deal is Bitcoin, and it's on sale. And so we buy the Bitcoin, we buy the digital credit, and we don't kind of sweat what the price is. We look for, the next opportunity. And I think, this is, we're kind of getting our bearings here, and we're looking at how do we continuously raise capital, and how do we show the market, show everyone that you do not need to be public. Like, being a public company is sure is helpful, right? But you can be a small private company, and you can run a similar playbook. There might be small nuances, but you can more or less do this, and you can do it for different industries, and every industry is going to have a byproduct, right? Our byproduct is, because we're a real estate operating company, we're able to capture these tax incentives and utilize it, where an individual investor may not be able to use those tax incentives. And so we're stacking, these tax incentives. We're stacking the digital credit, and you can replicate it from a different type of business, and maybe you find that you unlock a different type of tax shield or a different byproduct.
I mean, I think just if you break it down to just the most simplest form is, real estate investors are already doing this, right? They do it every 5 or 7 years when their real estate loans comes due, right? They recapitalize it. All you're doing here, or what you just described, is you've taken that recapitalization event from a once in every 5 to 7 year period to, I'm doing it every month, right? And you're basically describing where you're doing it, every week, and potentially every single day, and that is a lot more accretive to your investors.
Yeah, the financing cycles are compressing, and I don't think it's just real estate, but real estate has a lot of compression to go, because it is that long duration asset. And typically, like, you were refinancing once a decade, twice if you're lucky, right? If rates fluctuate enough, and you built enough equity in the property, or you added enough value and increased the cash flow of the business, then you got two refis in a decade. And to your point, like, we're compressing that. We're trying to compress that so we could get, two, capital raises a month. Maybe it's a mixture of whether it's technically a refinance, or if it's a non-recourse loan, because what we just did is non-recourse, right? Like, we want to show that we can take capital and put it to work quick, and grow the balance sheet in a number of different ways, right? Like, we have this capital stack where the mortgage is like the top, um, at the top of the stack, and now these non-recourse loans are underneath that. And we're trying to build out our capital stack as a real estate operator, and we'll see what else we can add to that. But right now we have basically our secured lender, our mortgage, and then we have non-recourse loans underneath it. And we'll
So
see what. Yeah.
So for the real estate person that's watching this, and they get the concept that you're talking about, but they're saying, you know what, Kenny, Chris, Tim, this is too fancy. This is too much engineering. I'm not trying to get involved in all that and overcomplicate things, right? There's going to be those people out there in the market. So why, for those that have that perspective, right? If we bring it back to the basics here, why the heck are you buying Bitcoin and digital credit for the real estate? Well, from an operational standpoint, it gives you that optionality, right? It gives you the flexibility that we keep talking about here, episode after episode, to bridge gaps in the operation of the real estate more effectively. What do I mean? I mean, covering a vacancy, doing a tenant improvement build out, right? Weathering a softer real estate market. There are a number of different scenarios that this Bitcoin and digital credit capital buckets are applicable to. And I think that is what a lot of the real estate folks are missing, or actually maybe not miss, but are going to find value in, is by allocating some of your free cash flow to these other buckets, right? You are increasing the overall resiliency of the asset, right, to handle whatever market conditions or situations arise that real estate folks are used to. Depending on the property and the market that you're operating in, it could take a year or two, right, 12 to 24 months to backfill a vacancy, right? Like, that's a lot of carrying cost that you got to have a reserve in place to handle, right? Once you find that tenant that wants to come in and occupy the real estate, there's significant upfront capital costs from the landlord's perspective to get that lease done and that tenant in the space. So you are unable to do that effectively when you are strictly operating in dollars, right? That is the problem that every real estate investor, every landlord in the country across every property type is figuring out, or they're trying to figure out, I should say, right? Deals don't pencil. How many times have you heard someone say that? You had a real estate event, or you saw it online somewhere. Deals just don't pencil. We're trying to make sense. Well, there's a lot of reasons why the deals don't pencil, but the biggest reason is that the pace of debasement is outpacing everything else in the real estate equation: rents, expenses, etc. So we are now using these new tools, whether it's Bitcoin or digital credit, to optimize and enhance the real estate.
Yeah. And speaking of other tools, I know we wanted to touch on, I saw some news where Yardi, which is a property management software, is thinking about AI and like how to interact with AI, and they've made the decision to give the property owners tools to export their data in a way that they can share it with Claude. And Claude can kind of get a bird's eye view of your operation and give you insight and feedback, and once so we're going to see like a continued trend for real estate operators to adapt these new technologies: Bitcoin, digital credit, AI. Like, those are the three leading technologies for the next decade, and it's going to become pretty clear. I mean, we're seeing people build on Stretch and offering banking services and dashboards where you can take in your revenue and convert it into Stretch immediately. And it's only going to be a matter of time before that's built into these platforms like Yardi, right? Like, I can see a property management software where you can run your CRM, your business, your property, and you can also receive like payments and put it into Stretch or digital credit or Bitcoin right through your property management software. I think that's where this is going. So like, you're going to
Interesting.
connect you're going to connect your Yardi software to AI and Bitcoin and digital credit, and it's going to turbocharge your business. That's how you're going to be able to get these tax advantages, and you're going to be able to increase idle cash, your operating reserves, like you were mentioning, and you're going to be able to control it at light speed, because you're going to be able to, if you need to convert it into cash to pay a bill, you're going to have it all in one place. And I think that's where this is going. It's going to be a convergence of Bitcoin, digital credit, and AI and management software in the real estate world.
Yeah, I agree with you. I mean, if you can if you can integrate all three into a single dashboard and make the process completely seamless, I mean, that's, that's the biggest onboarding mechanism we've talked about to date, right? At least for the real estate people. Yeah, wow, I didn't even think about that. I mean, Yardi is one of the largest providers in the industry. I think we use it here at my office.
Yeah, so we use Yardi for our retail shopping centers and like for like an overview of our storage facilities. But just seeing that they're, not dragging their feet and they want to kind of, stay ahead of things here. I think that's like very telling because, a lot of software as a service, a lot of SaaS companies are, at the risk of being blockbustered, right? If they don't adapt and keep an eye on this stuff, somebody's going to build an alternative, and maybe that they, build it internally themselves, or maybe it's a small team of one to three people that ship a new software that bundles these things together, or has like a more um has like just like a better like all-in-one solution. So like they got to be thinking about the future competitors, like how fast they can be spun up, right? Over the weekend, you can have an idea and you can have a prototype, be testing it and launching it on Monday.
You better tell your agent tonight before you go to bed, Kenny, to build this dashboard and not to make any mistakes, because we're integrating it on next Monday. Like that's what tonight's project is. Tonight's homework.
So I was kind of like thinking of that kind of stuff, and I came across. I think I told you guys that there's I'll give a shout out to Castle. I'm curious of what they're doing. They have a stretch and Bitcoin and cash kind of Stripe platform, and I'm hoping to learn a little bit more about it. We're going to have their founder on in the next few weeks, I think next month, to come talk about it. But something like that merges with some property management software is all you need, and yeah, very excited for the future. Like staying on top of this stuff has almost become like a full-time job, right? Like just you don't want to miss out. You want to be able to utilize the new tools, and um you just don't want to fall behind because everything's moving so quick.
Yeah, and I think the important piece here is just start, right? Just like the Bitcoin community says, get off zero. It's the same thing here. Just get off zero, start poking around, start figuring it out, see what the interface is like, see what the experience is like, and go from there. It's they're all very self-explanatory and intuitive systems when you get in there, and at that point you're really only limited to your own creativity to some extent. And yeah, I agree with you 100%. We've said it the last couple of weeks on the pod here is that, successful real estate operators in the future are going to be experts in 3, 4, 5 different areas, not just real estate and construction any longer, right? They're going to be experts in those too, obviously, but also Bitcoin, AI, and energy you're going to have to be a multidisciplinary expert in order to outcompete in the marketplace. Tim, I think you have a special announcement for everybody.
He might have dropped off. We might have to carry this one until he returns here. But another thing I wanted to touch on, so I know we're getting into the weeds here, and we like to tie things back to real estate, but there was an important announcement made by.
Quick note for property owners listening to the show. If today's discussion sparked questions about how these strategies might relate to your own building or portfolio, we're always happy to have a conversation. No sales pitch, just a thoughtful discussion about your property, your capital structure, and the options available in today's market. You can find our contact information in Sorry, guys, the delay killed us.
Oh, it's all right. We're doing it live, so it's the raw cut. But yeah, before the announcement, I kind of wanted to touch on the level of innovation in the space with Strive, who is another issuer of digital credit. They have a preferred SATA or SATA, depending on how you like to pronounce it. Um, they announced that they will start paying their dividend daily. And they had on True North, they had a little bit of backstory how dividends came to be from the Dutch India company, and then real estate, right? Real estate's always in the middle of this. In 1969, it was like First Realty or Realty something, Realty Zero. I should know this because, but they issued monthly dividends, and now we're here with the daily dividends, and I don't necessarily think it's gonna create a huge like return advantage as far as like a drip investment or reinvestment, but what I think it's gonna do is stabilize the price, and we've already seen that they're, you know, over I think we're just about 2 weeks away from their next ex-dividend date, but they're already trading at par. And, this is just, you know, you blink, you miss it kinda stuff because every week there's stuff happening, and just wanted to bring that up because the innovation is just happening so quickly.
Yeah, it's a full-time job learning these AI systems, and it's a full-time job staying up to date on all the current events. There's just not enough hours in the day. I agree with you there, Kenny, as far as the hopes of the daily dividends dampening the volatility. It'll be interesting to see how that all shakes out. I mean, from my personal standpoint, I don't necessarily have a big need for daily dividends, but if it enhances the overall instrument, then that's probably a net positive for the broader ecosystem here. So it'll be interesting to see how it unfolds. I think the overall market um, feedback was generally positive. I don't know if you saw anything to the contrary there, Tim.
It seemed pretty positive to me.
Yeah.
Maybe some people saying, there's no need for daily, but I would disagree with that because people can trade in and out. They can say, well, I'm going to try this for one day, right? It just kind of changes a lot of those smaller nuances that people might not appreciate at first.
I mean, Lynn Alden says it quite frequently as far, she talks about the velocity of money quite frequently. And I think this is just, part of that, right? They're trying to re-architect the traditional financial system to, run on, lightning speed. So it can keep assets like real estate can keep pace with, the technologies and the assets of the 21st century, kind of keep everything on one playing field as best as possible. I don't know. That one's above my pay grade.
Yeah, I think, what they did was kinda they shut the door a little bit on the arbitrageurs, like the guys that were coming in for 1 day, buying and holding and then getting the dividend for the month, and but I think, like, now they're gonna have, like, a new kind of arbitrage where they sit in SATA, and when the strategy dividend day comes rolling along, they hop out and they go collect the strategy by monthly, or until it's by monthly, and they collect the monthly one, or if there's a quarterly dividend payment, they buy that. If that's their name of the game is to do these arbitrage things, I think now they have like a whole nother kind of sandbox to play in because they can, you might see Strive SATA, like, instead of it like falling and like dipping on the day after the record date, like you may see it like just kind of dip on those few days, like once a month or twice a month, where Strategy's paying like has their record date, and so you could see them trading at par more days out of the month,
Hmm.
um, which is really good for digital credit because it's reduced volatility, dampened volatility, like you said.
Let's shift over to MSTR, because they hit the tape the last couple days here with, arguably just as big a news as the daily dividends, with buying back these converts. I think that, at least on my X feed, that it's felt like that went under the radar. Did you guys feel the same?
I saw it last week that I guess it was Friday, right? They announced that they bought $1.5 billion of their 2027 converts. I think it was like the 600 strike price. And I don't know. I should have looked into it a little bit more, but I don't know if they like delved into the details on, how they raised that capital, if they used their cash reserves or if they, because I saw on their filing today that they only did a small amount on the ATM on the common, and then they did a majority of their capital raise with Stretch last week, which I think many expected, and they were able to raise enough to purchase 25 or 24,000 Bitcoin. So now they're up to like 84 trillion Sats.
Yeah.
That kind of shows the difference between a billion and a trillion, right? 10 Bitcoin and 10,000 Bitcoin. It's kind
I,
of a
I thought it was really exciting because it's showing, it speaks to the optionality that we keep coming back here to, right? I mean, by doing that, Saylor is, decreasing the, the overall risk of the balance sheet, which a lot of the bears have, pointed to. So he's, kind of nipping that in the bud as ahead of time. But it also points to what you were talking about earlier, Kenny, is, creating diversification and making a balance sheet, bulletproof. So he's doing it with, in the financial markets and his business intelligence business. You're doing the same thing here, but with a real estate business. So to your earlier point, you're going to see this take place across all major industries and sectors of the economy. So, I think Jeff Walton says it best, right? I mean, not only is risk mispriced, but we're going from we're going into a time where investors are going to put a lot more emphasis on the strength of the balance sheet as opposed to the income statement. And you're doing it here, and Saylor's doing it there.
yeah. I think today's this week's episode, we were just gonna keep it light and just touch on some current events and our update from Westmain Storage. But is there anything else we wanted to touch
Westmain
on?
Storage went viral, dude.
Oh yeah, let's talk about that for a minute. I mean,
You're
that's
famous.
I don't know if I'm famous. Westmain Storage is famous. I still only have 200 followers on X, so
It's all right.
far from it. But yeah, we did get a lot of eyeballs. 110,000 views almost. Um, and that's pretty crazy. So I think that we're being rewarded for building in public. People are paying attention. They want to see like how a smaller company is able to um play in the same arena, right? Like, and this kind of goes back to something I've been saying is like there really isn't any moat. Like Bitcoin is accessible to anyone. Like any business can start building on Bitcoin. You don't need anyone's permission. And to what you were just saying, it's all about the issuer, right? Strategy is a software company. It doesn't surprise me that a software company is the first to kind of collateralize Bitcoin in the way that they have, because they're like a business intelligence company. But as different sectors start implementing Bitcoin and digital credit, they're going to find out that they unlock some byproduct that doesn't exist for a software company, that only exists for a real estate operator, or only exists for an R&D company or an AI company, or whatever it may be, right? Like there's going to be small, subtle differences. And I think that's where, Bitcoin treasuries are going. I call it Bitcoin Treasury 3.0s. You need an operating company, and that operating company needs to like have a differentiator from what Strategy is doing as a software company, or what Strive is doing as an asset management company, or Westmain Storage is now doing it from a real estate operator perspective. There's going to be another industry. I don't know what's next, but um, there's definitely advantages from each specific sector.
Yeah, it's going to turn into the the Westmains of the world are going to turn into the category leaders, just because they're not only going to withstand market fluctuations better, but they're going to print returns that are running circles around the competition. And that's at the end of the day, you don't need to learn digital credit. You don't need to go down the Bitcoin rabbit hole. At least most of the marketplace don't care to put in their 10,000 hours, which is fine. They're going to say, I'm a real estate investor. I know real estate. I'm looking for cash flow. What are my options? And you're going to see the forward-thinking real estate vehicles like a Westmain printing, double-digit returns with a lower risk profile, and they will disproportionately attract capital relative to the competitors in the space. That's going to take time to happen. It's not going to, be a flip of a light switch, but it will happen over time. And the only question at this point is, how much time does it take? Is it, 1 year? Is it 5 years? Is it 10 years?
Yeah, I think to your point on, you know, you don't like not everybody has to understand Bitcoin or digital credit, just like people don't understand how the internet works, or like how electricity is generated, or how a car, engine works, but we interact with these things and use them, and it's just going to become kind of like second nature. Like we don't most people don't understand how to build a website, but they have a website, right?
Yeah.
And so I think it's gonna take a lot of education, but I think that it like the amount of information is just only expanding. So like the education is going to become more available, and you're going to have people from different industries that can resonate and speak the language, like just like we're doing for real estate, right? We're able to kind of bridge that gap and put it in a real estate operator perspective. So we can use analogies that resonate with those people. And I think that's going to come for every industry, like we were just talking about. So you'll have these analogies, you'll have these um, aha moments happening all at once throughout, the whole economy, really. And I think it's getting turbocharged now, because financial advisors are going to be picking up the phone, dialing you and telling you that you need to allocate to Bitcoin in the next 6 to 12 months. We're seeing Charles Schwab and all the brokerage firms, integrating Bitcoin. I saw it's on their website now, but you still can't trade Bitcoin. But it's like right there. It's coming. So we're at the forefront of this. It's very exciting. It's only going to get better.
Agreed. I was having a conversation with a friend of mine over the weekend about the digital credit products, or as we call it, digital rents. And he has not went down the Bitcoin rabbit hole. He's not tuning into True North every Wednesday. He's got better things to do. But his first question to me was, how the heck are they paying double-digit returns? And all I had to tell him was, Bitcoin's appreciated, the underlying collateral's appreciating at 30+% a year. The issuer is stripping out the volatility and giving back the first 10, 11% of that return. And he just said, oh, okay, great. Sounds like a life insurance policy, right? My return's capped. I get it. That conversation happened in literally 90 seconds. And he was like, oh, that's interesting. What's the ticker?
Yeah, it's easier to explain and understand. And I think, when we started diving into this back really in December, January is when we started getting all these wacky ideas that we've implemented some of them, and um, yeah, I think Stretch is like the Trojan horse, or like digital credit, digital rents is the Trojan horse for Bitcoin, because you start seeing it perform, you start seeing it work, and then you're like, wait, like maybe I should allocate to Bitcoin itself. So it's kind of like an easier way of orange pilling somebody, because you don't really have to go through the whole orange pill right away. You just give them a taste of it with the Stretch, and then if they like what they see, they can kind of dig deeper and spend more time learning about the underlying asset that's powering it.
That's exactly right. We ready to wrap this? Got any other thoughts on your mind today, Kenny?
I think we wanted to keep it kind of light today and just kind of go over our recent purchase at Westmain, and kind of explain the thought process behind why we went 50-50, and yeah, I think we accomplished that. So that's it for me today. What about you?
I think you got it there. I think you said it perfectly. So I won't get too long in the tooth here.
Awesome. Well, that's it for today's episode. If this conversation was useful, please share it with a partner, a client, or somebody making real decisions in the marketplace. New episodes of the Real Estate Standard drop weekly. Until next time, stay disciplined, think long term, and stack sats. This is the Real Estate Standard.
If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market.